Hi there, my name is Jeff from Azure Network. Welcome to our FAC session. So today we're going to be covering the standard IAS 32, which is a financial instrument. Right, so let's get into it. Right, so sometimes you find students struggling to comprehend what a financial instrument is all about. But the first thing that you should note is that it is a contract, right? That gives rise, right, to either a financial asset, okay, of one entity and financial liability or equity instrument of another entity. All right, so what is a financial asset? All right, it is any asset that is cash, all right, that is cash or equity instrument of another entity, all right, comma, a contractual right to receive cash or another financial asset or contractual right to exchange financial assets and liabilities under favorable conditions. Okay. So let's use an example, all right, that I'm going to share on the screen to explain when it comes to a financial asset. Then we shall get into a financial liability. Okay, so we've got transaction one, all right, it reads as follows. On 1 Jan 2013, Global purchased 100,000 ordinary shares in what? In Excel, right? These were acquired at fair value on transaction date, right? So we shall discuss when it comes to fair value amounts later on, right, in the month. But today my focus is to explain how a financial asset arises and in whose books it is recorded and what would have happened for you to say that this company is going to recognize a financial asset. So as you can see here, right, we are saying global purchase, right? Global purchased 100,000 ordinary shares in Excel. You understand? So that means here he is paying money, right, to access these shares in Excel, right? So let's go to the whiteboard for further explanation. So based on our example, we'll say this one A is your global, right? And your B is your Excel. All right. So we are saying that A, right, paid some money, right? We don't know how much it is. They didn't tell us. So we don't know the price per share. But all we know is that in turn, right, for exchanging or for giving B the money that they desperately needed, right, B gave them how much? B gave them 100,000 shares. All right. So in other words, we are now saying that A is now a shareholder of B. And then if you go back to that definition that says a financial asset is any asset, all right, that is cash or the equity instrument of another entity. So this is satisfied from this example because we are now saying that, yes, we are receiving the equity of another entity, right? A is receiving 100,000 shares of B. You understand? So that means in the books of A, right, this transaction will be accounted for as a financial asset. All right, so it will be accounted for as a financial asset. It is still an asset, just that the difference is, remember, we normally associate PPE as an asset, intangible asset, as an asset, right? But we have an asset called a financial asset. Understand? So it's cash or in the form of shares of another company, right? It qualifies as an asset, but it is a financial asset, right? So I hope that this example will assist you to understand, right, how a financial asset arises, right, from this situation. Okay. So remember, I'm just trying to explain on the financial asset. I have not yet got to the financial liability. So if we're going to jump onto transaction 2, it says on 1 December 2013, Global obtained a short-term loan of 20,000 from Excel, and is required to repay the total loan within 90 days, right, which is 3 months. The loan is still outstanding on 31 December 2013, right? So here we have a second situation, right? Global desperately needed money, right? And fortunately, Excel had the money. You understand? Excel had the money. So let's go to the whiteboard. Right. So as you can see, Excel had the money this time, right? For transaction 2, Global, which is your company B, right, wanted or was in desperate need of the 20,000. So Excel was able to lend the money to Global. All right. So now we are now saying that, right, after 3 months, which was your 90 days, right? Global should pay back the what? 20,000 to Excel. So that means, can you see that from the definition, right? From the definition, we can see that this also qualifies as a financial asset, right? Why is that so? Right? Because Excel has a contractual right? Has a contractual right, to receive cash, right, in the form of a loan. Okay, a loan repayment, right, which is your loan receivable as well. Okay, so because of that, we are now saying that this will also qualify as a financial asset because the definition of a financial asset is satisfied from this scenario. Okay, so it's not only limited to equity, right, based on the first transaction. Transaction 2 is illustrating that there is the cash. You give someone money, right, they need to repay you after a certain period. So in your books, you that is giving out the money, right, or the investor, okay, that is seen as a financial asset. So the asset definition is satisfied. Okay, it is satisfied, right? If you go to the definition of an asset. So basically, that's how you identify an item if it is a financial asset or not. Otherwise, thank you very much. Until our next lesson, have a good day.